Welcome back, everyone. I'm Crypto Nomad. It's been a few intense days in the crypto world, and tonight I want to take a step back to reflect on what happened during the October 10th, 2025 market crash. No hype, no predictions, just perspective. This is not financial advice. It's a moment to understand what happened, why it happened, and what it revealed about the market we're all part of. October 10th started like any other Friday. Bitcoin was holding between $120,000 and $125,000. Then within minutes, the floor dropped. A single violent red candle sent Bitcoin from a high near $122,500 all the way down to about $104,800. Ethereum followed, sliding from $4,395 to around $3,460. Solana swung from roughly $224 to the mid-$170 before finding a bid again. In just over an hour, billions in long positions were liquidated. Order books vanished, charts turned red, and exchanges began throttling trades. It wasn't just a correction, it was a full-scale shockwave that tested every part of the ecosystem. So, what actually caused it? The spark came from the tariff announcement between the US and China. Traditional markets wobbled and crypto reacted instantly. Liquidity dried up as bots tried to exit at once. High-frequency algorithms misread the volatility spike, triggering mass short positions exactly when longs were already unwinding. Some exchanges paused to protect liquidity, but that pause only amplified the panic. When too many systems pull back at once, a digital market can cascade faster than human traders can react. The October 10th crash wasn't about one project failing. It was about how interconnected everything has become, how a single event can ripple through every chain, every token, every wallet. By the time the dust settled, Bitcoin had fallen nearly 15%, but it quickly stabilized near $113,000 by the end of the day. Ethereum clawed back above $3,800, and Solana rebounded from the $170 toward $200 again. So, was it catastrophic? No. Was it painful? Absolutely. It was a reminder that crypto volatility hasn't gone anywhere, and yet the market still found its footing faster than during past crashes. That's progress even if it doesn't feel like it in the moment. If you are watching it unfold live, you remember the feeling, the lag, the red wicks dropping lower by the second. You press sell and nothing happens. You refresh and your portfolio has already changed. That helpless moment when the infrastructure itself freezes, it's every trader's nightmare. We like to think the system is decentralized, but when APIs fail and liquidity pools empty, it all starts to feel very centralized again. The October 10th crash exposed that fragility. It showed how dependent the market still is on a handful of critical exchanges and liquidity networks. Now, I'm not into conspiracy theories, but on-chain data did reveal something interesting. The night before the crash, several large wallets moved tens of thousands of Bitcoin onto major exchanges. At the same time, short interest spiked across futures markets. Maybe it was coincidence. Maybe it was preparation for the tariff shock. Either way, the market moved before the headlines hit a clear reminder that in crypto, information travels fast, and liquidity follows whoever moves first. So, what did we actually learn from October 10th? Lesson 1. Leverage is a tool, not a lifestyle. When Bitcoin swings $18,000 in a single session, even a small multiplier can wipe out an entire position. Lesson 2. Liquidity is fragile. If one major provider freezes, every exchange connected to it feels the shock instantly. Lesson 3. Automation still needs human judgment. AI-driven bots and quant models act fast, but they can't measure fear. Lesson 4. Survival beats speed. The projects and people who plan for pain are the ones still standing afterward. Again, this isn't advice, it's awareness. Understanding risk is part of learning the market. Crashes, as painful as they are, tend to reset the space in healthy ways. Developers fix vulnerabilities, exchanges improve risk controls, analysts look closer at real liquidity flows. Historically, every sharp correction is followed by a period of rebuilding and innovation. I don't think the bull run ended on October 10th. I think it paused to clear out excess leverage and remind everyone that crypto is still a developing frontier. When I started Crypto Nomad, I didn't want to predict prices. I wanted to understand them. October 10th reinforced that mission. Markets may run on algorithms, but they're powered by emotion, fear, greed, confidence, curiosity. Those emotions write every candle on the chart. Surviving moments like this mentally, emotionally, and technically is what shapes you as a participant in this space. So, What should we take away from the October 10th, 2025 crash? Not fear, not regret, but perspective. The market didn't vanish, it reset. It taught us something and gave us a chance to grow stronger. If you're here listening to this, you're part of that progress. So thank you for staying curious, for asking questions, and for being part of this evolving story. This isn't the end of crypto's journey, it's another chapter. I'm Crypto Nomad. Stay grounded, stay informed, and as always, I'll see you in the next one.